Well, good afternoon, everyone. Thank you for attending the Department of Housing and Community Development's webinar series, Buying Into Be More. My name is Eric Lee, and I'm the Neighborhood Development Officer for one of the many regions in Baltimore City. We welcome you to this webinar, one of many that we've conducted over the last few years, and we're honored to have Baltimore Community Lending as our presenter this evening. Baltimore Community Lending is a partner with the City of Baltimore to strengthen underserved communities through innovative financing and flexible financing that they'll speak to you about tonight. We look forward to hearing from them. The format for tonight is that they will give a 20-minute or so presentation, of which at the end of that, we will entertain questions for the team at Baltimore Community Lending. You are able to put your questions in the chat and we'll address them at the end of the presentation. Please keep yourselves on mute as the presentation is being given tonight. And if their time permits at the end of the presentation and we've answered all the questions in the chat, we may open it up to to a verbal question and answer period, and we'll play it by ear. And again, my name is Eric Lee. I'm a Neighborhood Development Officer with Department of Housing and Community Development. We also have with us our leader in that department in the Development Division, Teresa Stevens, and she is the Director of the Marketing and Outreach in Community Marketing and Outreach. And we also have with us Danielle Reynolds, who is our admin staff to help with facilitating the question and answers tonight. So without further ado, I want to introduce Sean Russell and his team from Baltimore Community Lending. Thank you, Sean.
Thank you very much, Eric. I hope everybody can hear me fine. If not, Eric, let me know. My name is Sean Russell. I'm the Chief Lending Officer with Baltimore Community Lending. And I want to welcome everyone to this workshop. And I want to thank you for attending, and hopefully we will provide you with some information that's helpful. I'm joined tonight, and you will hear from some of the rest of the real estate lending team at Baltimore Community Lending. You'll hear from Tracy Evans and Deirdre Presley, who are two of our loan officers who basically do all the real work to make sure that we are providing flexible financing in the city. And so we look forward to the discussion and the question and answer, and I think we can get things started. So in tonight's workshop, next slide. In tonight's workshop, we're gonna do a couple things. We're gonna give you a brief introduction to basically Baltimore Community Lending and who we are and what we do. We're also gonna talk through at a pretty high level, but some of the development process, ways and types of project funding, and then give you some helpful tips on the loan application process as to what you would need to supply and how that would work. And then, as Eric noted, we're going to have a question and answer session. Next slide. So Baltimore Community Lending, we're technically a U.S. Treasury certified community development financial institution. We are mission focused, and we have been in the city for over 33 years. But basically, all you really need to know is that Baltimore Community Lending has a loan fund, and we provide flexible real estate financing. Next slide. As a community development financial institution, we are mission-based. And we are a nonprofit loan fund, and we have a mission that's stated right here. Basically, we'd like to work with underserved communities and basically further stabilize them and bring flexible financial assistance to help make these projects happen. Next slide. Just to give you more information about our service area, Baltimore Community Lending does work in the city of Baltimore, but we also now provide resources in the surrounding counties, as you can see here. And the map on the right also shows it pictorially. For our real estate loan fund, I would stop here and note just one thing. We do have a small business non-real estate loan fund that's been in existence for about 4 years. And if there's any questions about that, we would be happy to put you in touch with our small business lending division and our small business loan fund. But we provide access to capital to small and medium-sized developers and work on revitalizing and strengthening neighborhoods. We also provide technical assistance and capacity building training for developers that may have some additional needs and resources. But we really like to try to bring innovative and flexible financial assistance to the projects that are being done in these critical communities that need help. Next slide. This slide outlines basically all of our types of loan types and the various guidelines and provisions around those. And I won't go into that. This information will be available after tonight. But basically, this gives you a general outline of types of loans that we're able to provide. I will note that the guidance line of credit, the one that's all the way on the left, is really for more experienced developers, not first timers, because it's a pretty complex loan. Next slide. Things you need to know when trying to leverage financing. So we'll move to the next slide, and I think this is where I turn it over to Tracy Evans. Tracy, take it away.
All right, thank you, Sean, and good evening, everyone, and welcome to this session. I have the pleasure to share some information with you tonight about the development process. And so, generally speaking, there are 4 major phases in the development process. All are equally important, but they all basically start at the same place as what the phase that we call the pre-development phase. And during this phase, you're going to work on your planning for the project, site control, acquisition, design, selecting a contractor, budget estimating, and sourcing funds for your project. All of this happens during this phase, which we refer to generally in the industry as the pre-development phase. As all of those components come together, you then transition to the pre-construction phase, followed by construction and sale or occupancy, depending on the type of project. We do finance both projects that are being developed for sale, or projects that you may want to hold in your portfolio as rental properties. Next slide, please, Roy. One of the things that we wanted to make sure that we highlight for you all tonight is that as you assess your understanding for the development phases, it's important to determine your strengths and weaknesses. So the takeaway here is that becoming a property developer can be very challenging, yet rewarding if done correctly. So you must ask yourself, do you have the expertise to do this? And if you don't, what are your options? And some of your options clearly are going to include hiring a competent, licensed, experienced construction contractor. You may also need to hire an architect, project manager, or construction specialist. Next slide, please, Roy. So at the top of that list that I just went through, in terms of those subject matter experts that you may need on your team, is the contractor. So what is that contractor's role? It's critically important to the success of your project. And generally, you're going to look to them to oversee your construction project. That's the component or the third party that's going to be responsible for hiring subcontractors like the plumbers and painters and electricians and so forth that you may need to complete your project. The contractor is going to be responsible for obtaining permits and managing your project through inspections so that it meets city inspection and zoning requirements. And that contractor is going to keep your project on time and on target. They're going to help you manage to the budgets that you set, and they're going to be your go-to person for successfully completing your project. So you want to make sure that you hire someone that's experienced and licensed to be on your team. Next slide, please. You may also need to hire other professionals, and they may be equally important to the development process. It just depends on the scope and scale of your project. And so you're going to need to determine if you need an architect or an engineer. And those licensed professionals may help you develop a thorough understanding for your project specifically the design process. They need to be licensed. And they may work with you on both renovation or new construction projects. These types of subject matter experts can be critically important for both types of projects, renovation or new construction. In terms of selecting these individuals, you really want to do your research, make sure that they have experience and track record, especially with cost estimating. And you want to understand the services that they provide. Are they just going to deliver a set of project plans to you? Or can they bring other experts like mechanical or civil engineers that may need to be brought to your project, depending on the scope, again, and the scale of your project. And so these are just a few of the highlights that we wanted to cover for you for the development, understanding the development process. And now I am going to hand it over to my colleague, Deirdre, to talk to you more about project funding.
Thank you, Tracy, and good evening, everyone. Like Tracy mentioned, I'll be touching on project funding sources and some of the application process. Here we have personal funding sources that can possibly be used for your development projects. Quite often, these are the first sources of funding that you'll be utilizing to start a project and resources that you might have easy access to. But know that each of these sources are a great source and could help you get your project done, but there are sometimes when these sources don't provide quite enough funds to be able to complete a full renovation project. It really is based on what type of project you're proposing. If you're looking at a project that is just a moderate renovation or acquisition and moderate renovation, or if you're looking at a property that is a full gut renovation or new construction, sometimes these might be limited financing sources and you would have to look to other places to be able to get that done. In that sense, you would be able to look to community development financial institutions or CDFIs like BCL or traditional bank financing. CDFIs, like Sean had mentioned earlier, we're mission oriented. We are more apt to be able to provide technical assistance to persons who are newer to the development or real estate development area. If you need some guidance, we're more able to provide those types of assistances. Typically, CDFIs have more flexible financing opportunities, and the cost and fees are generally a little less. CDFIs can be a great source of financing for your project. Especially for those who are not so experienced or starting out. Like I said, it helps with walking you through the process in many areas and giving you some better understandings of what it is that you need to do, what the process looks like, and what you should expect moving forward. However, traditional banks are a viable source of financing as well, but typically they have more stringent requirements that you might need to meet. Their loan to value requirements might be lower than those of a CDFI, meaning that you would have to put more equity or cash into the proposed development project. And that's typically lowering what you would be able to profit as a developer of the property. So these definitely are both viable ways that you can go to get your project done, and are great sources to look into. And the last of the sources I'll be talking about is non-traditional sources of funds or hard money lending. Typically in your hard money lending scenarios, they will have higher interest rates and fees and lower loan to value ratios, in which meaning that you'll need to provide more out-of-pocket expenses or funding to get your project done if you have a regulation or that requires you to have higher input from yourself as far as equity, or their loan to value ratios are lower, meaning that if they only fund up to 65% of the loan value, where many CDFIs fund up to 75 to 85% of loan values after repair values to projects and developers. So just things to think about. It definitely is a viable option, but you need to make sure you weigh the pros and cons of each to make sure whichever funding sources are right for you in your project. And next, I want to touch a little on the loan application process. As far as loan application process, some of the things that you might need for presenting a loan application to any funding source, whether that be a CDFI, a traditional banking institution, or a hard money lender. There's some things that you're going to need across the board, and you want to make sure that you're able to present those initially when you move forward with a request for financing to any of these institutions. Typically, you should have a narrative or a summary of your proposed project. It's a best practice. You need to be able to put your best foot forward. And this is an opportunity for you as a developer or investor to tell your story, provide that input to the lender to let them know who you are, what your intent is, what it is that you want to do, what kind of project you want to put forward into the market, and what that looks like to you. And that talking about the things that Tracy mentioned in the development process, what that team looks like. Do you have an experienced team? Are you experienced yourself? If not, what does that team look like? So this is your opportunity to put that best foot forward, provide that information to your lender, and get that best turnout. Hopefully that you're getting a commitment from that lender to move your project forward. Also, you want to make sure when you're looking at an application that a lender typically will provide you with a checklist of items that need to be put forward. Also, and you need to make sure you work your best, your hardest to put forward all of the information that's requested at the time you're submitting your application, because this also tells a story about who you are, what you can do, how you do things, and making sure that you have everything up front, because not every lender will give you an opportunity to come back to make those corrections. So you want to make sure you're putting out there first. What you'll need additionally to look at to make sure as a part of the checklist, you're looking at providing a clear picture about who you are and what your project is, but also about your financial character. They're going to ask for information regarding your personal financial statements, wanting to know what your income is versus your expenses, and you need to be able to paint a clear picture telling them what it is that your revenues and sources of income, what kind of savings or investments and things that you might have to show who you are as far as your financial character, and as well as what your liabilities are, making sure that you clearly define what those are, just so the lender could understand what your capacity is to borrow and what level that borrowing could be assessed at. You're going to look to make sure you have an updated financial statement if it's less than 60 days old, your income tax returns for at least 3 years, and deposit and verification information, making sure that whatever you put on your personal financial statement, that you're providing documentation to verify what it is that you're saying, like so that you have at least 3 months of your most recent bank statements and in 3/4 of investment statements if you do have those. So make sure you check off that checklist, making sure you're providing all the information and tell your story, making sure that you're putting your best foot forward the first time around. And next here, I'm going to stop and turn it over to our loan associate, Roy Miller, and he's just going to talk to you about some basic details about how you can contact us and what our processes are.
Sure, good. Thank you, Deirdre. Again, my name is Roy Miller. I'm the loan coordinator, and I'm actually the beginning of what you submit to Baltimore Community Lending. You'll speak with me initially about the application, and I'll provide you with information as to what our criteria is as far as the lending process, the length of time that it may take to get your application through to underwriting and eventually into an approval status. And then also I will work with you all the way to the closing date. I will assist you with the documentation that is required, alternative documentation if that is necessary, and just overall correspondence will be between you and I as it pertains to the initial and right up until the closing date of your application process and approval process. I am available through direct line at the number that is shown on your screen, 410-862-0938. That is my direct line. Generally, you will find me here every Monday, Wednesday, and Friday, 9 a.m. to 5 p.m. I am also available daily, 9 a.m. to 5 p.m. via email, and that is roy.miller@bclending.org. As it is noted here, you'll submit a complete application as directed by myself and the criteria that we require here at BCL. Your loan application fee is as follows. For nonprofit organizations, it's $250, non-refundable. And for for-profit entities, it is $350. That is also non-refundable application fee. If you have any further questions with regard to our process, don't hesitate to reach out to me via telephone call and or email.
So that concludes our presentation today. And now we turn it back over to you, Eric, and see if we can work forward to answering any questions that
Great.
might be in chat.
Thank you. I want to thank the team from BCL for the presentation tonight. There was a few questions that were placed in the chat. And I know that I think your staff was answering some of them. Teresa, are you on to go through the questions that were placed in the chat?
Yes, I'm here. I do believe Tracy may have addressed them. I'll start from the last question that we received. Is Baltimore Community Lending's loan application fee comparables as fees charged by comparable to fees charged by traditional banks?
So generally speaking, I'll try and take that, Teresa, and thank you for the question. Our application fee is competitively priced to what you would pay to another like lender. So remember, as Sean mentioned at the top of the presentation, we are what's called a CDFI, a Community Development Finance Institution. So we are a nonprofit lender, and normally a nonprofit lender's fees are going to be slightly less expensive or more affordable, I'd say, than a traditional bank. There was a question in the chat about, like, what's the difference between a CDFI, which is what Baltimore Community Lending is, and a traditional bank. So a traditional bank is going to be more like, your regulated depository institution that also makes loans. So it could be a commercial bank, Wells Fargo, Bank of America, Fulton Bank, banks like that, regional or national banks. Or it could be a savings and loan, or it could be a credit union, but that's more of what we refer to as a traditional lender, and their fees are generally going to be more than what a CDFI like Baltimore Community Lending is going to require. Does that answer the question?
I think so.
It seems very like it did answer the question. Thanks so much, Tracy.
Teresa, this is Kathy. It didn't really answer my question. My question was about a slide that had discussed distribution of funds. And on that slide, one of the bullets said managed by lender in terms of the distribution, and the other one for CDFI, and the other one said regulated by the lender. So my question was, what's the difference between managed and regulated in terms of loan fund distribution?
Sean, do you want to try and cover that one? Because I'm not.
Um,
with the
Yeah, I guess what I would add to that, everybody, is that, I mean, I think maybe it was a semantics thing where basically it's, I mean, both loans are going to be managed by the actual lender. I think that, with a traditional bank, there is, traditional banks are regulated by, by the OCC and the Federal Reserve, and that causes them to, they may be, through their regulated nature of what they're regulated on, they may be not as flexible with some of the things that they can do. And I'm just trying to think of an example as I'm talking through this, and I'm not coming up with anything. But I think loan to value is something that would be looked at from a regulated institution the higher you go. So if you went above 80%, I think a regulated institution might have some difficulties doing that. Whereas BCL is a CDFI, where we manage our loan fund, we're not regulated by a formal institution like the OCC or the Federal Reserve, and so we can, by exception, and this is approval from our board, we can look at doing loan to values, for example, in excess of 80% in exceptional cases. So does that help with the question?
I think, Kathy, that was your question.
Yeah, that helps a little bit. Thank you.
Okay, great.
There is another question. Does Baltimore Community Lending lend for renovation costs only in a situation where the owner owns the home free and clear, but would like to renovate the home to refinance for a 30-year mortgage?
Okay, so just to clarify, we're a commercial real estate lender in our real estate loan fund. We do not do consumer 30-year mortgage or consumer loans. So these are commercial transactions for developers that are actually producing and rehabilitating and stabilizing properties for income purposes. And our loan terms, as was outlined, and we probably didn't have enough time to show that slide, are not 30-year loans. Even for our investor loans that are, say, a construction mini permanent, after the construction and stabilization term of the loan would convert at that point to a kind of amortizing mortgage, which we would look at probably letting it amortize on a 20-year schedule. However, it would not have a 20-year term. It would only have an additional 5 to maybe perhaps 7 years before there was an actual maturity and what they call a balloon payment.
Yeah, the product slide is in the presentation. That might help if Roy, you can scroll back to that one.
I believe that the question was with regard to whether or not they could already own the property and just get a construction loan for those for the purposes of rehabbing. Is that what your question was initially, if I'm not mistaken?
I'm Mr. Derek
I
Howard.
said yes.
Okay.
Okay, yeah.
Yeah,
So,
we do that. We do provide construction loans for property that you already own free and clear. It's just not for owner occupants, is what I believe Sean is referring to. You still need me to go back to that slide?
If it helps, just I think we've addressed it though, that we
yeah, I
are
think it's
not a
clarified.
Yeah.
residential mortgage lender. We are a commercial real estate lender. And the distinction there is that the borrowers that we lend to are not owner occupants.
Okay, I want to try to get as many questions in as I can. Next question is, what is the credit score needed to qualify for a loan?
I'll take that one. We don't have a standard or specific credit score that we are a minimum credit score that we require, but we do look at credit scores. We do look at it as a part of your history and understanding what your capacity is to repay loans. However, we also understand that things happen. So based on situations in each individual loan and request that's submitted, we look at that. If there is some issue where let's say there was a medical issue that, you know, reduced your credit score or had some bad effects on your credit score, we can look at that and understand that, and we could work to a mitigator for that. However, if you had some credit issues and you're currently in the midst of a credit issue, trying to work through that, saying that you have late payments in the last 12 months or so, that's something that we would look to you correcting and saying that we would need you to have a little bit more time working on getting that credit repaired and taken care of, and having, you know, on time and consistent payments before we would work to move a loan request to underwriting. So not a specific number, but we definitely look at it, and it's in an individual by individual basis.
Thank you, Deirdre. I believe this question may also be part of that conversation. Are loan packages approved by the underwriters and your board?
The loan packages are recommended by the underwriters, and our loan committee makes the decisioning whether to provide commitment or not.
Our next question is, if BCL's mission is to help developers in underdeveloped areas get their projects completed and revitalize these areas, why does BCL pick and choose the areas? If BCL chooses only to assist in the areas that are already developed or show development, how will these underdeveloped areas ever progress and bring the city back to its greatness in all areas?
Well, this is my opinion.
This is
I'll start
John.
first. Oh, go ahead, Sean.
Yeah, no, go ahead, Deirdre, that's fine.
I wouldn't say that we pick and choose the areas that we are going to work in. We typically, as a policy, look to work in low and moderate underserved areas in the city, neighborhoods rather, and we use the census tract to guide us on whether that census tract, that area, that neighborhood community is low or moderate income. There might be some issues where if someone brings a project to us and there's been no development in that neighborhood really, and the project might not be financially feasible, meaning that it might cost more for the developer to renovate a property in that neighborhood versus than what they would be able to sell it for or rent it for. That's where we might just have a discussion of saying that it might not be feasible at that time, because a market probably needs to be created. And sometimes it's very hard to do so if you're just doing one property at a time. And also some of the underserved neighborhoods that might not have a lot of movement in them are very underserved, and there are a lot of vacants. And we try to put our financing sources in situations or projects that are being impactful to the community or that neighborhood. So we wouldn't want to put, say, $150,000 into a property that is in the middle of two vacant properties. So it's not specifically picking areas, but it's being strategic about which areas are feasible and based on their low and moderate income designation.
And we'd also like for you to discuss, and it can be challenging if you're developing a property in between two vacants or on a block where you're renovating one house, but there are 10 or 15 vacants on the block. And part of the reason why that becomes challenging mainly for you as the developer is because if you're developing that, let's say that house for sale, buyers may have difficulty getting mortgages because the mortgage that's going to, that buyer's going to have to apply for to purchase the home, that lender may say, well, that house is in between vacants, or there are more vacants on the block than there are occupied units on the block. And so some of that is driven externally, not so much by us, but by the other critical, financiers and lenders that have to make a project successful. So we're one part. We're, acquisition, construction, renovation. But typically then you're either going to be looking to either sell the property or rent the property. And in the scenario that I just described, we're talking about for sale. But what if you're planning to rent the property? In that scenario, how likely is it that you're going to be able to get an individual to rent a house that's in between, many vacants? The last thing I'll just add to that is, impact is important as well. And, many developers, work with, for example, the city of Baltimore to try and acquire multiple properties, vacant properties on a block, so that you can get that momentum. I think that the person who posed that question was asking if you can get multiple properties and you can create stabilization and impact there, then that might, be an opportunity to try and move forward with and pursue. But to just support what Deidre said, we don't necessarily say, we want to lend in one block versus not lending in another block. There are a number of, factors that play into how that all works out.
Thank you, Deirdre and Tracy. The next question is, what's the range of interest rates that you've provided on recent loans?
So what are we generally lending at? Prime plus 2%?
For the construction period.
Mm-hmm. And our minimum fluctuates based on what's happening in the markets. And right now, our floor is 7% based on our cost of funds.
Thank you. Next question is, what if you have two houses on the block and the rest of the block is leveled? The houses were demolished and the lots are well maintained. Is that a scenario that would be acceptable for this lending opportunity?
I would say that we should have a conversation about that, and we would need to look at the general area and the rest of the block, just to make sure. We want to make sure that you're going to be successful with your project. So we want to make sure that you and the neighborhood are going to be successful. I mean, one of the other things that we didn't mention is that we want you to be doing something that's consistent with what the neighborhood is looking for. There's over 200 neighborhood associations in the city, and they are very vocal. Some of them don't want to see more rental properties in their area. Some of them, are fine with it. But we need to look at all these things, especially since we work in the neighborhood with you. And so we want to make sure that collectively we're stabilizing neighborhoods, and we're basically providing good outcomes both for you and for the neighborhood.
Thank you, Sean. Thank you, Deirdre. So a new question was just asked. I do want to add that this webinar is being recorded, so the PowerPoint presentation, the dialogue that we're having now, will be uploaded to the DHCD YouTube channel by this time tomorrow around 5 p.m. Our next question is, what is the path to acquiring vacants that are owned by out-of-state and even out of the country investors who are doing nothing with those properties, however, are not willing to sell them for true community economic development and affordable housing development? And I think this question might also be part DHCD. And there are strategies that we are working on block by block, dependent on the neighborhood. And we are working very closely with our code enforcement partner to address those privately owned vacants. I would love to know if there's a particular block that you're referencing, Ms. Peters. So please feel free to email me or give me a call tomorrow.
Yeah, I don't think
question.
BCL has much. I don't think BCL really has much to add to that. I mean, we're here to provide the flexible financing for those properties that you can get control of and that you can be doing, the good works of stabilizing, blocks and neighborhoods. And so we really don't have any more leverage than you do against, remote property owners that aren't aren't doing anything, but I am well aware that DHCD is working on that. The state is also working on that through the various, fundings and grant sourcing. But I know that that's a very important focus for DHCD, and we support them in that and provide them with input on that every time that we get the opportunity.
Thanks, Sean. Our next question is, what strategies have you seen less experienced or financially resourced developers use to either fill the gap between market value and cost, or meet any lender guarantee requirements in order to receive financing?
So those would be some of those sources of funds that Deirdre covered in the project funding session, a portion of the session. And the ones that we list are savings, your personal savings, home equity. Some folks, create investment clubs, and those individuals pool their resources to come up with the funding and or grants. Working through the grant process is definitely a learned skill. But these are some of the ways that, newer developers come up with the funds to meet their equity requirement for the project.
And I'll add to that, and Amber, thanks for the question. The appraisal gap, or the difference between market value and cost, is something where really grant money is the primary focus and source of being able to cover that. The state of Maryland had some appraisal gap legislation, which was approved, but to my knowledge, it hasn't been funded. But what we have seen others use, and usually it takes partnering with a nonprofit or CDC, because they have the resources and can qualify for grants and get core money, for example, or get community legacy money, for example. And then basically, if they can garner those subsidies, then basically, if you can partner with them, they hopefully will be able to use some of those subsidy monies and grant monies they have, which are soft. So they don't need to be repaid. So it can be really be used for covering that gap. So, I know others that have been successful in doing it. We've seen, some organizations like Southwest Partners have access to that. Maybe also Upton Planning, I believe, has some resources that they're doing for projects where basically they actually got grants that could be used to help cover with the appraisal gap.
All right, I think that might be our final question from the chat. I'm going to turn this over to Eric Lee, and thank you all so much for these questions.
Yeah, and Teresa, before you do that, I want to again thank everyone in the audience and everyone from DHCD for the opportunity to speak with you this evening. I think Roy's provided his contact information, and we look forward to hopefully having discussions, and maybe more importantly, having the ability to help bring resources, financial resources and lending resources to the projects and the valuable projects that you're planning.
So feel free to call us.
Okay, thank you. I want to thank again Baltimore Community Lending for the work that they're doing in our communities and the presentation tonight. Please reach out to them with any questions that you may have regarding financing. And also, for those of you that participated, we again thank you and invite you to visit our DHCD YouTube channel, where not only this presentation, but previous presentations are available for you to review. Thank you again. We look forward to working with you in eliminating the blight and improving the living conditions for all of Baltimore City. Everyone have a good evening. Be safe, be cool, and enjoy the rest of your summer. Thank you very much.
Thank you again.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.